A gloomy Friday in Johannesburg, but not on this show. Good afternoon and welcome to this edition of Finweek Money Matters. I'm Nozi Pumbandra, and together with my co-hosts, Finweek Deputy Editor Tandisizwe Mahlutshana and Finweek journalist Jessica Hubbard, we will help you manage your finances and give you some of the latest trends and trades of the week. Now, we also know that 2013 has not been a year filled with many listings on the local bourse, but property stocks have taken a liking to the JSE of late. We'll unpack listing on the local securities exchange and then get into the rather contentious issue of executive remunerations and share incentive schemes. And finally, with BEE codes recently updated, what does this mean for business? We found out all this and more in the next hour. Remember to send any comments or feedback to moneymatters@abn360.com. But now, let's get started. Some ring bells and some cut ribbons, but in South Africa, we blow a kuri horn to celebrate a new listing on the stock exchange. In its cover story this week, Finweek takes a look at the listings of 2013 and the money being made in the space. On the desk with us now, we have Patricia Kula, Business Development Manager at the JSE, and Chris Pretorius, Director at Deloitte and Touche Sponsor Services. Everyone, thank you and welcome to the show. Tandisizwe, now you authored this particular article, and I'm sure you must have seen some benefits to listings. Can you share these with us?
Absolutely. I think I started by looking at some of the biggest companies that we have on the exchange, and one tobacco company, British American Tobacco, is actually worth over R1 trillion on the stock exchange after listing, I think around about 2006, 2007,
right,
at about 560 billion, about half of that. So it tells you that, you know, if you stick it out, and what, you know, investors would always tell you, or, you know, investment managers and fund managers would always tell you, if you want to make money in the stock market, stay in the stock market. Don't worry about fluctuations of going down and up. So we thought we'd actually just go and try and find out who has been listing over the past few years,
right,
what has been, you know, attracting them to list on the JSE, but also, you know, give advice to every other business person that's out there who may want to list their business at some point. I've met a couple of you know, good entrepreneurs, and they're saying the ultimate goal, the ultimate benchmark of success, right, in their businesses is to finally list one day.
But when is the right time to list? I mean, not every company, Patricia, is going to be a British American tobacco company. It's not going to go into trillions of rands in what was been 6-7 years. So as a company begins to think about that journey, when do you think it's the right time?
So timing is the $1 million question, or R1 million question, because, you know, timing the market is very important. But the important thing about listing is about getting the rationale for listing correct, getting the strategic objectives out there into the public, and really giving the company an ability to raise capital. So, for example, if you have a company that's looking at taking the business to the next level, listing is just one of those platforms that can take that company to that level.
What would be some of the wrong reasons to go for a listing?
You know, I think there's a number of reasons. You know, it's listing, like I say, you've got to have your strategic objectives in mind and right. I would say listing would be done on the wrong reasons. If your mates, for example, list and you decide, you know, oh, it's the greatest next thing to do, it really needs to make strategic sense for the business. It's not a quick win. It's not a quick cash out. It's a long-term strategic objective for the company.
I say generally anything that you do because your mates do generally becomes a really bad idea. But maybe let's come to you, Chris. I mean, Patricia speaks about strategic objectives, and I want to unpack these a little bit. What are the basic fundamentals that should be in place before we, you know, a company even opens up itself to the journey towards listing?
Yeah, obviously it must be listable, meaning it should be of sizable nature, definitely not too small. If it's too small, it just won't attract any attention, and obviously then liquidity will suffer because there are very little shares to trade. And when coming back to strategy, the listing itself would be part of a strategy. You can't really list and then think, oh, what now? Now I'm listed.
Right.
You're in the spotlight, the JSE looks at you, you've got all these regulations, and now what? So a listing I see, it would be part of that process, part of a journey. So your strategy might be to merge with another company, buy other companies, businesses and all that, and do it through a listing. So it's very careful to know why you want to list, then proceed, and once you're listed, you must then follow through. No, you just for the sake of being listed.
And would you agree that the more listings an economy has and a market has, the better it is, and it's a sign of a healthy, functioning business environment?
Indeed. Especially overseas, also obviously locally. So as of late, quite prominent listed companies.
You can't really compare the kind of hoopla that companies in, say, the States get when they list, on Facebook, sort of, or we have Twitter listing as well. You can't really compare the media attention and interest that garners to local listings. Is that correct?
Yeah, obviously it's different markets, but as of late, a couple of dual listings, so we actually get the best of both worlds. So like companies listed in specifically the UK and Australia as of late, a couple of mining companies. We actually get the best of both worlds.
I think from a profiling perspective, we engage with companies all the time about the prospects of listing. I think the biggest rationale for a company to raise or to list is, number one, capital. Secondly, the second benefit that we see, and that companies that have listed, and we always tell them, once you are listed, you get huge profiling benefits. You actually can't quantify that, even in the local market.
Right.
The reality of it is that banks, suppliers, your customers will look at you differently, and it's something intangible. I mean, it's something very difficult to put a value to. So I think from a local perspective, you definitely do get a lot of exposure, not only locally but also internationally. I mean, from an exchange perspective, 30 to 40% of our trade is done by foreign investors.
Right.
So you also get international exposure.
I think one of the interesting things that I found during this investigation was that over the years, since about 2008, there's been a decreasing number of companies going to list. One would now imagine that it should be the other way around, because companies want capital and they want access to capital. The question is there appetite within the markets to say, we want more companies to list? We've got, cash hoarded somewhere where we can give these companies more money, get more options within the stock exchange to put money in. Is that appetite there?
There definitely is appetite. It's looking at coming onto the market from an investor perspective. We are constantly hearing from investors. When are those other companies coming to the market? When are they coming to the fore? It all boils down to the company at the end of the day. If you're looking at raising capital, irrespective of whether the company is liquid or not, if I believe in the management, if I feel that the fundamentals are right, and if I believe in the rationale for listing, as an investor, I will invest in that company, irrespective of whether it's listed or not. And from an investor perspective, there certainly is interest.
Now, maybe to you as well, Chris. Here's a company. It's cash flush. It's got brilliant products. It's got the right audience. It is selling products like hotcakes. And the next logical thing for this company is to list. But the guys are saying, actually, we don't want to list. Now, if they were to list, what would be some of the things that they would be actually sacrificing within that business?
Yeah, of course, one is privacy. So all of a sudden, they're like in the public domain. There's a lot of kind of obligations, especially post the listing, post for IPO, for instance, King 3 compliance, the JSE regulations, more regulators looking at them, so all of a sudden they in the public. Whereas previously they were not.
You quoted a mining consultant in the article, Peter Major, who said that governments around the world fail to appreciate and encourage enough companies to list. Would you agree with that?
Not to list.
Not to list.
Not to list.
Because of the regulations and the...
Look, it's a fine balance. It all depends what your end game is. I mean, if your strategy comes back to strategy, if the listing is part of a strategy, I don't think that will bother the company or the management or the board. But obviously, with a listing, there are other obligations, but I think those obligations are smaller than the benefits.
Let's take a couple of steps forward, and I'll bring you back to your comment, Patricia. When a company takes the decision for a secondary listing, what are the considerations that they have to take into account at that particular time?
So from a consideration perspective, I mean, why a company will seek a dual listing, and there's been a number of companies that have come out into the market signaling that they might be looking at a secondary listing. I mean, there's a number of benefits. You know, why a company would list, for example, in another jurisdiction is to use their shares as currency to make acquisitions in that market or outside of that market. And also diversifying shareholder base. You know, just the point on regulation. You know, regulation is very important, and we take investor protection very seriously. You know, at the end of the day, companies list on the JSE to raise capital and to raise money. And from a regulation perspective, it is important that it's there to give you guys, the investor, security and credibility that the company is operating in a fit and proper way. So, and also from a company perspective, you know, regulation is never a bad thing, because irrespective of whether you are listed or you in the private space, King still applies to you. All those principles still apply to you. And at the end of the day, if you've got all the proper procedures and management structures in place, it will actually aid you to make decisions in the proper way.
I think we've kept most of the conversation confined to big businesses. I mean, let's look at the medium-sized enterprise. Perhaps, Chris, you can come in on this. You know, what are the benefits for them to consider getting onto the LTEX or in any other way getting listed?
That way primarily to grow. So for instance, once you're listed, you can use those shares to buy other companies. So if you're unlisted, you're probably limited to bank finance or some debt. So once you're listed, the awareness goes up, you achieve more credibility, and it's easier then to go and buy somebody else. So that would be the primary reason for if you're a smaller company, so like AltX, or maybe a small company on the main board.
I can already think of a question that many small business owners are thinking right now is, how much will this whole process cost me?
Yeah, look, it obviously depends on the size of a company and the amount of capital to be raised. But probably a smallish company, about 2 to 3 million rands to get listed. That's the ones of cost at the time of listing, and obviously when you've got your ongoing costs. A medium-sized company about 10 million, and obviously when a large company about 20 million upwards.
What would be a good decision to delist?
Delist is if you've got limited trade in your shares, loss-making company, and no interest from investors. So the question then is, why being listed?
And I'm sure Tandisizwe's friends, the small and medium-sized enterprises, are probably asking, do I get my 2 to 3 million back in that regard?
Yeah, you get it back over time, not immediately.
And how common are delistings? Does it happen quite often? And what are the circumstances around it?
Yeah, there's, I mean, judicially, the stats probably, the smaller companies, probably more of those have been delisted. But there are also a couple of takeovers where another company takes over another listed company through a scheme of arrangement typically, and then the other company gets taken over.
So from a schemes of arrangements perspective, if you look at the recent delisting, now in this particular point in the market, there's a lot of consolidation. Most of the delistings have been as a result of the schemes of arrangements, which Chris alluded to.
Now, I just want to go back to the road to listing, especially from the perspective of the small business owners, my friends. So I've got the money, I want to list. I have to appoint an advisor or a sponsor. And I want to talk about the role of that advisor or that sponsor.
Yeah. Okay, let's talk main board first. You need a sponsor, you need a corporate advisor, you need auditors, attorneys, you need the JSE, and also you need the company. Obviously, the advisor, that's like the pinnacle running all of this. That would be the management of a project. They need to do the structuring, they need to do evaluation of a company, and they need to place the money. If you're talking AltX, you need a designated advisor. Basically the same process, just smaller, but virtually the same process.
Now,
go ahead, Tandisizwe.
Now that advisor, after successfully listing, what is our relationship like going forward? Yeah,
if you list it, then you must have a sponsor at all times and a DA, a designated advisor of your AltX. If you are active, what I mean active, a lot of corporate actions, for instance, buy and sell, or a rights office, then you typically also use a corporate advisor, and that corporate advisor will also look for opportunities. So like say we were advisors to a company, they might say, look, on our shopping list is to look for similar companies, or we want to sell something, merge, etc., and you would use that corporate advisor to do that for you.
That's interesting. Can I say no to that advice? Because if I go back and say, when I listed, I had this strategy. I had point A, point B, point C, and you're coming with point Z, something that I never thought of. Can I tell my advisor that actually no?
Yeah, you can.
So
Yeah.
what we do from an exchange perspective is, from an Altex, we've actually implemented a directors induction program, and that program is there to equip CEOs and directors of those companies and give them the knowledge of the listing requirements, corporate finance, insider trading, all of this stuff. So an advisory role is very important, but it's also important for the directors themselves to upskill and have the relevant information to make the right decision.
So it sounds as if help is there, and unfortunately that's where we have to wrap this conversation. Thanks again to Patricia Kula, Business Development Manager at the JSE, and Chris Pretorius, Director at Deloitte & Touche, sponsor services. Remember that for these and more stories, get your copy of Finweek Money Matters on shelves today. It's also available in both English and Afrikaans on mysubs.co.za. But before we head off to our quick break, let's take a quick look at our Finweek Trade of the Week. This week's Trade of the Week is British American Tobacco. Now let me come to you, Tandisizwe. Solid company, has had solid performance and solid results. Why are we looking at them at this time?
I think first of all, I must issue out a disclaimer: I do own units in the business.
All right, taken.
But maybe this is why I think it's one of the most innovative companies that I know. Now, you may remember years ago there was an introduction of the ban on cigarette advertising,
Right.
and everybody thought, ooh, this industry is going down.
Right.
But there's the likes of BAT that are so innovative, that are finding ways to get to the consumer, that are finding ways to make this thing that's called smoking less taboo,
Right.
more acceptable, more sexy in a kind of way, if you will.
You feel a bit ashamed of saying that. It's okay.
There might be parents listening, but so even though cigarette sales continue to decline globally, challenged by a variety of things. There's it's because of legislation in other
Right.
markets, in other regions, but it's also because of this counterfeit thing that's coming about, and that's just taking markets or market share away from the actual businesses that are selling genuine products. But even so, the company continues to be innovative. It's now a leader in in this thing called capsule cigarettes, in relocks, in additive-free cigarettes. Those are, additive-free cigarettes are those cigarettes that don't have added
Are they
stuff.
doing e-cigarettes?
Yeah,
That's
they
becoming
actually.
Is this
they-
the electronic
Electronic
cigarette?
cigarettes. Now that's very interesting because they recently launched it. Now when electronic cigarettes launched 4 years ago, everybody thought this is the next big thing. But there were, market commentators who said, actually this thing is a fad, it will die down. Now you look back, it's actually died down. Now BAT has come back and said, actually now that market has been forgotten, let's introduce something more exciting about electronic cigarettes. And actually the uptake is very, very promising. So I'm a buyer. I will continue to add when I have cash on this thing, but the share price is actually not cheap. It's about 538, 540 rand.
Right. It's an expensive buy, but it's a definite buy from your
Absolutely.
point of view. Of course, that's with Tandisizwe and his e-cigarettes and e-smoking tendencies. I won't go into that. But time now for us to pay the bills. We'll be right back after this short break. Welcome back to Finweek Money Matters. Now, executive remuneration is a hotly debated subject, and performance-linked share incentives have been proposed as a good way to align shareholders and staff goals. However, these incentives are often poorly constructed and misunderstood by investors. We take a look now at what works and what doesn't. Paul Hunter is Senior Consultant at Hay Group, and Craig Gradage is Director of Investments at Gradage Mahura Investments. Both join me in studio now with my co-host. Thank you so much for making the time to come in again. Perhaps let's come to you, Craig. Are share incentives the answer to that alignment that seems to be missing between performance, retention, and shareholders?
Yeah, I think it's part of the answer. I don't think there's any one answer. I think Paul could probably answer that better than I can, but having been part of these schemes myself, if you're in a large organization, you still have that feeling of hopelessness that you can't really impact the bottom line meaningfully. But certainly if you have a 3-year tie-in and the incentives are meaningful and well structured, it can have a meaningful impact.
Paul, do you think that they addressed the retention dilemma?
So when we look at designing incentive compensation schemes, you would normally look to ensure that there's alignment between shareholders and managers, that you provide enough leverage or upside to drive the type of performance that you're looking for, and that there's a strong retention component to the incentive scheme design. Now, shares were popular throughout the 90s because the thinking was, well, the best way to align your managers with your shareholders is to give them some equity.
Right.
But more recently, the market is moving away from that because, first of all, at lower levels in the organization, there's no link between or line of sight between what I do and the share price at the end of the day. So it doesn't really drive behavior.
Right.
The other thing is that probably 75% of the movements in a company's share price are driven by extraneous factors outside of the company's individual performance. So you can end up rewarding people because the oil price, for example, moves by a huge amount or whatever, and you get into the realm of things like windfall gains, which are against the code of ethics as per King 3, for example. So shares are not necessarily always the best way to align the managers with the shareholders.
The trend you've noticed is that these schemes are becoming less popular and less common? Is that what you're noticing?
That's right. There is a trend in the market to move away from employee share option schemes to cash-based schemes, especially at the more sort of middle to lower levels within the organization. So we still see a role for them in rewarding senior management, but at lower levels there are probably better ways of rewarding people and retaining people these days and through ESOPs.
Let's look at the benefits to the company, and perhaps let me throw this to you again, Craig. From a cost and a tax perspective, are companies really benefiting from implementing these schemes?
Yeah, again, look, I mean, from where I sit, we generally deal with employees when they're making decisions in terms of exiting the schemes. So I think Paul would be better placed to
I'm
answer
going to
that
get
question.
you on one at some point.
So I understand, Marau, to from an employee's perspective, when they're making decisions around what to do with their thing. So I think
okay, we'll get to the conversation around the exit. Perhaps let's throw the curveball.
I actually wanted to just chat to you very quickly about the employees wanting to exit.
Yeah.
Now, you are tied in obviously over a 3-year period or 5-year period.
Yeah.
And you feel like you have done all that there is that you can do to this company. It's time to move on. Do you have any leeway to say, actually, can I cash in my shares?
Yeah, so it depends how the ESOP is structured. So typically after a 3 or 5-year period, all or a portion of the shares would vest. So they would now become unrestricted, and you as the employee would have access, and you would have a couple of decisions that you can make, whether to transfer the shares to a share portfolio, whether to cash them in, if it's options, whether to take the cash upside. And as an employee, there are a whole host of factors that you need to consider in terms of making the best decision.
But you have no space to maneuver within that first 3 years.
So in the first 3 years, well, that's so they're structured in order to, if there's a retention aspect to, skills retention aspect to having that ESOP in the first place, then yeah, that's it. You have to wait until that vesting period arrives.
Sorry, I know I'm probably getting onto this. Is there research somewhere that says when you give employees these share incentive options, then is there a correlation between that benefit and their performance? Or are you simply keeping people because, or are people simply staying because they have a benefit at the end of 3 years?
So I think it depends on how the scheme is designed.
Right.
So a scheme that has sound governance should have performance hurdles or thresholds in place that determine eligibility for shares, the number of shares, the vesting, etc. In cases where employees just get a blanket grant of shares every year, there often isn't a link between performance and the shares given. And this is part of the problem, because people get shares every year. They don't understand how their behavior drives the share price or creates shareholder value.
Right.
And it becomes almost like an entitlement over time. So people feel that they're entitled to these shares, and it actually ends up pervasively driving the wrong types of culture and the wrong types of behavior in organizations.
Let's go back to the question that Craig was dodging about the actual implications on a company in terms of a cost and tax perspective. Is it a benefit for companies to actually implement these schemes?
Okay, so one of the reasons why the schemes were popular in the 90s is that there was no impact on a company's income statement in terms of issuing shares or issuing share options. There was an economic cost in terms of the dilution of the shareholders' equity capital, but no actual reported cost. And financial economists for a long period of time have said, but there is actually a cost associated with issuing these shares, and that needs to be reported somewhere. And in terms of the accounting rules, I think it's AC 139 has now been introduced where companies do have to show the cost in their income statement associated with the shares and the share options. That cost is deductible from an accounting or a reported profits point of view, but it's not in fact tax deductible to the company itself. So there is actually no advantage now to the company in terms of issuing shares over simply paying cash bonuses. And because there's no big perceived cost advantage, it's another reason why organizations are looking more seriously at whether to use a share incentive scheme or some other type of vehicle to try and drive and reward performance in the organization.
But it seems like people can just use accounting wizardry to sort of manipulate anything, and share incentive schemes are just one of those things that can be manipulated.
Right. Look, I think after your Enron debacles and the Sarbanes-Oxley Act, the accountants are tightening up on the reporting and trying to close some of these loopholes. And this was one of the obvious ones because you could give value away without reporting on that value that is being given away. But that loophole is in fact being closed. And that's one of the reasons why companies are moving away from share options, because they now do have to disclose the value that's being transferred from companies.
So they almost seem to have a bit of a tainted reputation, like they have a shadowy element to them. Is that
to some extent, people will say they encourage the wrong sorts of behavior. They encourage managers to take risks that they shouldn't because there's huge upside. So I guess a lot of the corporate governance issues that came out in the late 90s and early 2000s, a portion of that is associated with the incentive vehicles that drove that behavior in the first place. And that might be one of the reasons why there's a move away to a more simple or a more pure or a more honest way of rewarding people through cash type incentives.
I want to backtrack to an earlier comment that Paul made about it not, share schemes not being a very good vehicle for rewarding junior level staff. And I want to come to you, Craig, with this and say, how have companies balanced eligibility with available equity? And do you find that there might be trends within companies where share scheme options are available that lower management actually aspire towards that particular threshold?
Yeah, it's a difficult one because, these schemes are all structured very differently. I can talk from my experience. Very often there's an empowerment element to an ESOP, and you'd find that the senior black managers are getting more shares than your junior black managers, but are they more black than the junior guys? So is it about skills retention or is it about empowerment? And then whether this actually creates some kind of incentive or motivation. I haven't seen any studies to that.
Do you think perhaps, we talk about retention for the last few minutes. I want to look at attracting the right skills. Are you finding that these schemes are maybe used as a carrot now to attract black professionals in the empowerment game?
It can be, and again, it depends on the terms of the scheme and the what sort of waiting periods and vesting periods would apply and things like that. But what we, from our experience, we just see that if I'm working at company A and I'm part of a scheme, if I go for an interview, I simply include that value in my negotiations with company B. So it almost sidetrack or bypass that retention aspect, and it generally tends to be more attractive with listed companies because it's easier to create an ESOP than with an unlisted company.
Are companies at will to just create an ESOP the way they want it created, or is the process inclusive with employees, with labor, with employee representatives to say this is actually a much better, a more logical solution at the end of the day that we've created for our employees?
So what we would typically see is there are a number of stakeholders involved in the design of any employee share option scheme. If it includes your bargaining unit members or your unionized labor, they would obviously be one of the stakeholders that would be involved. You would include your management team, and then from a governance point of view, you need your remuneration committee as well as your board, because you need to make sure that the appropriate bodies are presented with the information, the cost of the scheme, and sign off on that body. So the design of any incentive scheme or share incentive scheme is quite a consultative process. And that's, so typically an organization would work with an independent expert like a consultant, and then all of these internal bodies from a governance point of view would be part of the process of designing and approving the incentive scheme.
When is a good time for a company, a listed company, let's say a newly listed company, we were just talking about listings earlier, when is a good time for them to begin to apply their minds to offering these schemes?
Well, they should do that right from the start. I mean, that's one of the things you want to have in place, because you want to attract talent and you want to drive that value creation. And often in the early days, you might, for example, have cash flow constraints, and you need to be quite creative with the way in which you retain and incentivize people. But that needs to be part of your